Good morning and welcome to the inaugural webinar for the Rainwater Equity ETF. My name is Patrick Carolyn and I'm pleased to introduce today's program. Today's webinar will feature Joseph Shaposhnik, who is the founder and portfolio manager for Rainwater Equity. Joseph will spend about 20 minutes discussing the investment strategy, 20 minutes answering your pre-submitted questions, and if we have time, answering any questions that the audience today has. Before I go any further, though, I need to read an important disclaimer. Investments involve risk, including the possible loss of principal. There is no guarantee the fund will achieve its objective. ETFs may trade at a premium or discount to net asset value. Investors should review the fund's prospectus carefully before investing. It's available at rainwateretf.com, or you can receive it by calling 424-278-1285. The fund is distributed by Quasar Distributors, LLC. This presentation is for informational purposes only and is not considered investment advice. And now I would like to turn it over to Joseph Shaposhnik.
Patrick, and thank you everybody for joining us. It's exciting to be able to connect with everybody now, 60 days post the launch of the Rainwater Equity ETF. We wanted to take some time to walk through the rationale for the ETF because we really haven't had a chance to connect with you directly and kind of share our thinking about why we started it and our objectives and how we go about doing business. And so super excited to be able to do that. I see that we have 7 people that are in the waiting room, so hopefully we can let them in, let them enjoy the presentation. But as Patrick said, we're going to take about 20 minutes to walk through the rationale and our investment approach, and then respond to pre-submitted questions, and then hopefully take a couple of live questions as well. So I just want to take a minute to talk about why I started the Rainwater Equity ETF and why I'm so excited about it. You know, I was at TCW for 14 years, 10 years as portfolio manager. Before that, I was at Fidelity. So I had spent a lot of time in the industry. And the reason I felt it was so important to start the fund is I felt that the investment industry, particularly on the equity side, was broken. Far too many managers underperform their benchmarks, and I had a very strong belief as to why that occurs. And the belief from all the experience that I had came from the view that most investment managers spend a lot of their time trying to make a decision on all of the different businesses in their benchmark, with the belief that one could predict 500 stocks if you put enough MBAs and enough brain power behind that process. I had a different view, a different view of the world, and my belief is that most businesses can't be predicted. That was my experience as an analyst at Fidelity. That was my experience as a portfolio manager for so many years, and time after time, I saw that. And so our view and our central belief is that we only want to invest in those businesses that we can predict. And those businesses that we believe we can predict are recurring revenue businesses. So our fund is the only fund that we know of that is based exclusively on investing in recurring revenue businesses that generate growing free cash flow. That's our view. And so from our perspective, the advantages of investing in a fund that exclusively invests in recurring revenue businesses are fourfold. Number one, our view for the advisors and for our investors is that they increase the stability of portfolios. Recurring revenue businesses tend to have a lot of contracted revenue, which creates a dynamic of very predictable cash flows. Second, because these cash flows are predictable, our managers of our businesses can take cash flows that they've generated and they know will come in the near future and reinvest those cash flows either to acquire other businesses or to invest in new projects that will create more growth for their companies. So in general, we think these businesses can grow more quickly than that of the average company. 3, in an environment where the indexes are very concentrated, more concentrated than they've ever been. These businesses add significant diversification to client portfolios and investor portfolios. We don't own most of the Mag 7. We own a lot of businesses that are small and mid cap companies, some large cap businesses, some global companies, some companies based in Canada, some companies based in Sweden. These are diversified businesses that don't look like that of the overall market. And in a world with tariffs, in a world that is increasingly uncertain, we think that businesses that have contracted revenue should hold up better. And lastly, we wanted to give investors access to a seasoned manager like myself, and in a vehicle that is easy to buy, easy to access, transparent, and something that is very tax efficient for investors. We looked at the data, and what we found is that on average, the average mutual fund generates capital gains that tax investors at a rate of 1.8 percentage points a year. So we felt as though our product in an ETF wrapper immediately is advantaged relative to the mutual funds that are available on the market today. Those are the four key advantages that we see when we evaluate our fund and what we're trying to deliver to our end investors. One of the reasons, and I'll get into a couple of slides which I think are relevant and make the point, why focus on recurring revenue businesses? Businesses are so very hard to predict. If you look at NVIDIA and you go back to 2022, NVIDIA stock went down 50%. And that was in 2022, not very long ago. And that was over the course of a 1 year period of time. In that 1 year period, the management team of NVIDIA sold $3 billion worth of stock as the stock was going down 50%. 1 year later, NVIDIA shares were up tenfold. The smartest management team probably in the world today, one of the best certainly in the world, couldn't see that their stock was going to, or their business, which typically stocks follow the performance of the businesses, couldn't predict that their business would be better off to such an extent just in a 12-month period of time. They left $30 billion of value on the table because even they couldn't predict where their business would be 12 months hence. So we try to take a very humble approach. And as I said, we only invest in recurring revenue businesses because we think we can predict them. Let me walk you through a couple of examples. I know many of you have had the opportunity to go through the investor presentation. And so I'm going to share it and just walk through a couple of examples, and hopefully this will be instructive and better explain what we're trying to achieve. Let's see if I'm able to share our slides here. Okay, everybody should be seeing the slides that we're sharing. Patrick, can everybody see the slides? Okay, Patrick's on mute, but I think he said yes. So I'll take that as a yes.
I can see the slides.
Okay, good. So I got to share the disclaimer, which our Chief Compliance Officer asked me to share. So there you go. The disclaimer is up, and it's been up now for a couple of seconds. I'm gonna go to our investment approach. It's very straightforward. We take a three-step approach to investing. Number one, we only buy recurring revenue businesses. I think I've made that point multiple times now. Number two, we only invest with strong leaders. I'll define that in a minute. And number three, we hold our stocks for the long run. We don't compromise on any one of these investment principles. I've invested in businesses which were great businesses and had poor managers. It didn't work out. I've invested in businesses that were led by great leaders and were average businesses. That didn't work out. So when we look to invest in companies, we focus on number one, they've got to be a recurring revenue business that has growth opportunities. Number two, they have to be run by great leaders, which we'll define in a minute. And number three, our view is that the money in investing is made over the long run, over the 5 and 10 year stretches, and hopefully longer. let's spend a minute on why we buy recurring revenue businesses. I've talked about it on a big picture perspective. Yes, it's difficult to predict most businesses. That's true. But why are these kind of advantaged? So let me spend a minute on that. From our perspective, it's straightforward. In general, it's very hard to run a business. So when you're running a business with thousands and thousands of people, it's difficult. It's difficult just to run it. So with a recurring revenue business, and that's a business that has revenue that's on contract. So think of a software company that's a business which is a monopoly business, like a credit bureau, where if you want to run somebody's credit, you have to go to the bureau to get the information. When you can foresee where your revenues will be in 2 or 3 years, it's far easier for the management team to plan its affairs. It's far easier for them to match headcount with where revenues will be. So expenses and revenues are much easier to match. Putting together a balance sheet with the right capital structure is much easier to do when you kind of can see where your revenues will be in a couple of years. So in general, these businesses create fewer financial disappointments, is what we say. I would shorten that and say they blow up less often. And so we're trying to avoid blowups. And so what my experience in managing the prior fund over the last 10 years is that you experience fewer disappointments with these types of businesses. Second, as investment managers and analysts, which is what we are, at the end of the day, we're always analysts. That's what we do. It's easier for us to value and evaluate these businesses because we can kind of see where revenues and free cash flow will be over the next couple of years because they're under contract. It's much harder to evaluate and come to a conclusion on a business that doesn't have recurring revenue and cash flow is wiggling like this, and we kind of can't figure out where the cash flows will be. And that's most businesses in the S&P 500 and in other sectors. So from our experience, we will create fewer investment mistakes if we just stick to investing in these types of businesses. And finally, and I talked about this a minute ago, it's easier for management when they have the confidence that the revenues will be there over the next couple of years to make the investments that are necessary to grow the business for the long run. So we think that it gives managers the opportunity to generate better growth because they have more confidence that their business and their capital structure will be intact over the next couple of years. So in general, more consistency, fewer surprises with these types of businesses. Let's go to the next slide. Where do we find these businesses? And I love this slide because it kind of describes what we're looking for and where these businesses are. And you can see that we're looking in all kinds of sectors. So where do we find these businesses? Aircraft replacement parts. They tend to have a monopoly position in parts that are sold on airplanes. So that's TransDigm, that's HEICO, that's Loar. Those are the businesses that have monopoly positions in selling the latch, the engine component, in some cases the seat belts. Shockingly, these are near monopoly businesses and they have a very predictable replacement cycle. We like that. Other businesses, stock exchanges. We own a stock exchange. It's the only stock exchange in the country. It operates rain or shine. The companies that list their securities on these exchanges have to pay an annual fee to be listed, and they have to pay a fee based on volume that occurs on the stock exchange. It's a monopoly or near monopoly business. It's very recurring and it's very difficult to disrupt. We own a waste management company. They have a monopoly on most of the local markets that they operate in, and they're vertically integrated, so they can kind of control their costs and they can kind of control their revenues. We don't think that waste management is going to be disrupted by AI. We don't think that stock exchanges will be disrupted by AI, and we think that airplanes are going to continue to fly regardless of how AI kind of affects that. So we like the durability of these businesses. We like the fact that tariffs are not going to have a significant impact on our companies. We like the fact that these businesses are dominant and have very recurring and strong positions. This is kind of where we'll find these businesses. I'm going to compare two businesses for a moment. So we talked kind of at a high level as to why recurring revenue businesses are advantaged. And now I want to talk about the numbers. On Company A is Constellation Software. It's a software company that provides thousands and thousands of software programs to hundreds of thousands of customers on an annual basis. 75% of all revenues are tied to 75% of revenues are tied to long-term contracts. So it's a highly recurring revenue business. And what do you see from a 75% recurring revenue business? You see very steady revenue and free cash flow advancing over the years, very predictably. Revenue is predictably growing, free cash flow follows revenue, and this is the kind of company that we just talked about. It's much easier for the management team to manage. It's less likely to have negative surprises, and it's easier for us to evaluate and value as investors. Company B is Ford Motor Company. The company has next to no recurring revenue associated with it. And so what do you see? Revenue in the black, it kind of wiggles around and it's going upward. But more concerning is that free cash flow is all over the map. It's positive, it's negative, it's up, it's down. And as an analyst and as a portfolio manager, we're tasked with valuing these businesses. And it's very difficult to value Ford Motor Company because, as you can see, there are years where the company generates, I'm just trying to get my slide here, generates no free cash flow. There are years when it generates $20 billion of free cash flow. That creates a very difficult dynamic for the company to determine what is the appropriate capital structure for them. And it creates a very difficult dynamic for us as investment managers and analysts to appropriately value this company. And this is why we favor the businesses on the left. Not surprisingly, because stock prices follow free cash flow. The Constellation Software chart looks nearly identical to the black line on the left, which is the free cash flow line for the company. Not surprisingly, because stock prices follow free cash flow, the Ford Motor Company stock chart looks similar to the free cash flow line on the right. Ford Motor Company stock, I looked at it this morning, has gone next to nowhere over the last 10 years. And that's because free cash flow has gone next to nowhere for the company over the last 10 years. Hopefully, that chart explains in numerical form why we favor these types of companies. With that, I'm going to go to strong leaders. Number one, as I talked about, we only invest in recurring revenue businesses. Number two, we only invest with strong leaders. For us, a strong leader is one that is a fanatic that has generated outperformance relative to its competition. When I say fanatic, actually, I'm taking the word that Warren Buffett used in his 1980 address to the University of Omaha. He described the leaders that he likes as fanatics. So, sometimes you come across leaders that I would call mercenaries. They're hired to kind of run a company for a couple of years. We're not looking for those types of leaders. We only want to invest in fanatics, and I'm going to get into a fanatic in a minute. And we want to ensure that they've generated outperformance. I think most investment managers look for great operators, and so I'm not so sure that point is very differentiated, but I will say we will only invest with fanatics. What I do think is very differentiated are the next 2 points, which is number two, we want to invest with managers that have incentive plans that are aligned with our core beliefs. So our core belief is that for stock prices to appreciate, the managers and the companies have to generate increasing amounts of free cash flow over the long run, and they have to do it while generating high returns for investors. So naturally, we will look at the ways management is compensated to ensure that their compensation is aligned with generating growing free cash flow over time. So many managers are paid on metrics that have nothing to do with increasing shareholder value. We take a lot of time and care to ensure that our CEOs, our leaders, are paid in a way that will create better value for us as investors over the long run. And that means compensation plans that are aligned with generating higher free cash flow and generating higher free cash flow while generating higher return. We'll talk about that in a second. And lastly, because our businesses generate so much in the way of free cash flow, we want to invest with leaders that have a record of allocating capital in a way that creates value for shareholders. I would shorten that to say we're looking for CEOs that are great investors. And so let me just take a minute and describe a couple of the CEOs. These are our CEOs. Nancy McKinstry, who is CEO of Wolters Kluwer, and for the last 21 years was CEO of the company. She just recently retired. She's an American CEO who took over a 150-year-old European Netherlands-based company. It was a dying dying maker of textbooks and medical information, medical periodicals based in the Netherlands. It wasn't growing. She turned it around. The stock has appreciated 13 times since then. Mark Leonard, who is founder and CEO of Constellation Software. I didn't know this, but when I was researching, putting this together, he was actually a bouncer at a club when he was young, and he's like 6'5". So it's kind of funny. Today, you would never know that because he's such a deeply thoughtful and intellectual person. Anyhow, he started his career in venture capital, and then he saw the opportunity to acquire these unloved vertical market software companies. And for the last 30 years, that has been his focus. He's still founder and CEO. The company has 70% recurring revenue, as you probably know, and the stock has appreciated 256-fold since the IPO in 2006. The last person I'll highlight is probably the youngest CEO of all of them in terms of number of years as a public company, is Dirksen Charles, founder and CEO of Lore. His company was acquired by TransDigm, and he decided, why should he give TransDigm all of his value? So he founded Lore 13 years ago to acquire other vertical market software companies. I'm sorry, to acquire other aerospace aftermarket companies. He took the company public about a year ago. The stock has been fantastic. What's most interesting about it is Lore, over the first 12 years of its life, has outperformed TransDigm and has outperformed HEICO, two of the best aerospace compounders in history. So we're really excited about him and the company. These are the types of leaders that we focus on investing in. Incentives. Charlie Munger said the basic rule on incentives is you get what you reward for. So I'm not going to spend a lot of time going over this chart. I think some of you have already reviewed this. But as I said earlier, we focus on investing with teams that are paid to grow free cash flow per share and generate higher returns on capital, because we believe free cash flow, we believe that stock prices follow free cash flow. Not surprisingly, this is the outcome when you pay somebody on free cash flow and higher returns on capital. I've got to wrap this up and get to questions in a second, but the last part of the investment process is hold for the long run. Our experience over the last 10 years of managing money is that the money is made in holding these great stocks for long periods of time. So unlike most, we don't use price targets. We hold these businesses as long as they continue to be great compounders. And so we believe we've got to give management the time necessary to execute their strategy, and we want to hold these winners for long periods of time. With that, these are the holdings. You probably have seen them as of June 30th. As you can see, all of them have a lot of recurring revenue associated with them. We didn't spend a lot of time on risk management, but when we built the product, we had the advisor in mind. And from an advisor's perspective, we want to stay focused in 20 to 30 businesses, but we don't want to be too exposed in any one business. And so you can see that we've capped the initial maximum position size for any one business at 10%. I ran a prior fund where we had much higher levels of concentration, and it worked out just fine. Our risk metrics were very, very strong, but we wanted to give the advisor added confidence that this is something they can buy for their clients and that they can sleep well at night knowing that it's focused, but it's not too focused. It's invest in recurring revenue businesses that can compound for long periods of time and generate, we believe, lower than market volatility for the clients as we did in the prior fund. And so we built a product that we think can generate strong returns and do that in a very responsible way. So with that, I think that I've run, let's see, 28 minutes. That's not terrible. I could have run for probably 45, but I just want to leave you with a couple of, maybe a couple of thoughts before we go to questions. Um, Number one, I built this product with my best friend's mom in mind, and let me tell you why. So my best friend, I went to UC Berkeley up in Northern California, which I thought was cold when I moved there. I'm from Los Angeles originally. I thought Berkeley was cold, and then of course after I graduated, I moved to Boston to work at Fidelity, and for a California boy, that was really cold. But as an aside, I met one of my best friends at Berkeley, and he's an immigrant from Mexico, and his family's an immigrant from Mexico. They landed in Northern California, and his family set up an automotive shop up in Northern California. He grew up in that business, and as I got to know him, I got to know his family and his mom. And when I launched my last fund, of course, when you launch your first fund, you go out to friends and family and you ask them to invest. And I went out to him and his friends and family and to his mom, and they invested, and I was very pleased by that. 6 months later, the fund is going well, and I'm excited about it. And so I kind of check in with him, and I say, how you feeling about the fund? How's your mom doing? And I think I asked, did she invest? Because I wasn't sure. And I like his mom a lot, and I want to make sure that she's happy. So he said, "Oh yes, she invested. As a matter of fact, she put her entire 401k in the fund." And so, of course, I was blown away by it. I was reminded of the great responsibility that we have for our clients. And so, when I manage this fund, of course, a good portion of my wealth is invested in it, and my family's wealth is invested in it. But in my mind, that's really secondary to everybody else. And so, I think a lot about managing this fund for folks like her. And hopefully I'm sure you think about your clients in the same way. So I think about Rainwater Equity as something that's very dear to me, as my prior fund was. And, we don't have ambition to launch 5 different flavors of Rainwater Equity or to build a multi-line investment management company. Our focus is to build a single fund to make it a great compounding product for advisors and their clients over the long run. And so that's the way we think about Rainwater Equity and the Rainwater Equity ETF. With that, I just wanted to let everybody know I will, in the event that they want to meet in person, I will be in New York in the first week of next month. I will be at the Investors Podcast Conference in Big Sky, which is next month. And then I will be in Vancouver in the third week of October. So, in the event that somebody would like to meet or an advisor would like to get together, feel free to reach out to us and let us know. With that, I've kind of stayed on time, and I'll turn it over to Patrick, who's going to go over pre-submitted questions.
Thank you, Joseph. We'll now move into the Q&A portion. The questions, as Joseph just mentioned, were submitted in advance. They touch on recurring revenue, valuation, the impact of AI management in uncertain times, lower insider sales, the fund's cash and SPY positions, and the firm's growth plan. Let's start with the first question. Joseph, this is from, I believe it's Nicholas. Reoccurring revenue. Our first question, do you view some types, like software subscriptions, as more valuable than others, such as smaller repeat sales of aftermarket parts?
It's a great question. Uh, we bucket the um, hold on, I'm just gonna adjust this view. Oh, okay. Well, look, I'm gonna be in this small window, Patrick. I don't know how to fix that, but I'll respond to that question. We look at recurring revenue in two buckets. The first bucket is uh, transactional recurring revenue. Oh, I've got a hand up now. That's cool. Oh, I got to lower my hand. Okay. The first bucket is okay is transactional recurring revenue, and the second bucket is subscription recurring. We put our businesses into two buckets. Subscription is always preferred. And so when I think of subscription recurring revenue businesses, that's the software company, that's the waste collection business, which has a monopoly on that market. That's a service that has a subscription. That's a Netflix type of subscription. That's a Constellation software type of business. We favor those businesses. They will produce that steady free cash flow and revenue line that we just looked at in the presentation. They can be disrupted like any other business. None of them are infallible. That's preferred. The second type of business is what we describe as transactional recurring revenue. That's a business like the aftermarket aerospace parts companies where they have a hold on the market, a monopoly position, but the growth will be driven by activity. And so activity in the case of that business is miles flown. In the case of credit bureaus, that's the number of pings or the number of inquiries that occur that drive revenue and free cash flow. It's not quite as good because you need to have activity to drive the revenue and free cash flow, but it's still really strong because you know that the US economy will grow over time and that the bureaus will see increased growth because of the transactions that will be needed that will need to occur over time. So we like subscription more, but we'll take transactional recurring revenue as well. Those two categories are very strong because we know the revenue will be there. The question only is when.
Great. And the second question is on valuation. Next, basically, how do you approach valuing equities, and are there particular metrics that you would emphasize?
Yeah, we get that question a lot. In general, our focus is to invest in businesses that are in our investable universe. And that means that we've put together a list of businesses that we believe meet our metrics, but for whatever reason are either too expensive or we like the businesses in the portfolio more than the businesses that are in the investable universe, so we haven't invested in those companies yet. And the way we think about valuation is we're trying to maximize projected free cash flow growth in the future relative to the free cash flow multiple we're paying for these stocks today. So we want to pay as low a multiple on current free cash flow for free cash flow that we think will grow quickly over time. We're trying to optimize the multiple that we pay for the rate that we project the free cash flow these businesses will grow at over time. In general, we're trying to pay a market multiple on free cash flow or a price to free cash flow that is at or near that of the overall market. Sometimes we have to pay up for quality businesses, but in general, sometimes we don't. When we first purchased Constellation Software in 2016, We paid a multiple that was commensurate with that of the S&P 500, and we thought we were getting a business that was much better than that of the overall market. So that's from a high level the way we think about valuation.
There are a couple of attendees who've asked a question related to AI. One of them was Nick. What impact do you think it'll have on some of Rainwater's largest holdings?
So look, I think we're obviously spending a lot of time thinking about this. In general, the portfolio, aside from the software businesses, has limited exposure to disruption from AI. We talked about aftermarket parts, talked about waste collection, stock exchanges. Those businesses don't have a lot of exposure to AI, but certainly the software businesses do. And so we've spent a lot of time thinking about that and evaluating that. And so, in our view, those businesses that have complex workloads and are deeply embedded in existing business processes and that are investing in AI to enhance their positions are clearly better positioned than others. And so those businesses that build software that engages in data retrieval, collection, organization, basic decision making, those businesses are at risk of disruption. And the challenge, of course, is that many of these businesses have been expensive for quite a long period of time. And so we believe with our businesses, they have been investing behind making AI make their products better, incorporating AI into their existing work processes to make their products better. One example of that is the incorporation of natural language processing and AI to the analysis of medical records that some of our businesses are collecting and analyzing. Before, you had to create a query that was scientific and almost scientific to get a good answer. Today, our businesses have added AI to make the query much simpler, much faster, and much more intuitive for the physicians that use the product. And so that is making that business better and more attractive for the client. And that's what we want to see from our businesses that are exposed to the risks and opportunities of AI. We only want to invest in businesses that are using it to enhance their product. If they're standing still, we're going to be evaluating those positions. If they're expanding their moat by utilizing it, we think that they've got strong positions because in general, we're investing in businesses that are selling something very special. They're not selling a basic retrieval product that is software enabled. They have unique data which they can monetize and they need to be using AI to enhance their positions.
That's great. The next question that came in is regarding macro, and it's kind of more specifically around management in the sense, how does your evaluation of leadership change during periods of political, regulatory, or economic uncertainty?
Well, we want managers that have a record of being able to navigate difficult times. And so when we evaluate our businesses and how we think they're going to perform, we look at history. How did these managers navigate the COVID pandemic? How did they navigate the Great Recession if they were operating the businesses back then? We want to make sure that we're invested with managers that have the skill to be able to make great decisions in difficult environments. But also, it makes it a lot easier to make great decisions when you have a much easier business to manage. So that's one of the reasons we want to stay focused on recurring revenue businesses because they're easier to navigate in difficult times. If you sell a software product or a subscription-oriented service that doesn't have goods that are going across the Atlantic, you're far less likely to be negatively impacted from a cost perspective, at least, by tariffs that are occurring today. And so, number one, we want to invest in businesses that have been dealt a great hand. They have 70% recurring revenue. They have a monopoly position. It makes it a lot easier for our managers to operate. But in general, we stick to our criteria of what we look for in managers. A history of outperformance and fanatics, naturally aligned with compensation metrics that align with making money for shareholders and protecting us, and a history of making great capital allocation decisions. In bad times, they can make bad capital allocation decisions. So we want to go look at bad times and see how they've done. So we think about the macro, we think about how the business is going to react in the macro in a difficult macro environment, and we look at their record when times were difficult as well.
That's great. Last two questions here. Truck lore. This is kind of a two-part question. It says, what happens to the ETF if something were to happen to you personally? And then second, are you concerned about the recent insider sales at Lore?
Okay, so I'll take the first. I'll take them in order. The first question is on what would happen if something were to happen to me. Uh, Obviously, we have an independent board of directors, which is very strong and very knowledgeable on investment companies. They are a board of directors on several of them. And so, if something were to happen, the independent board of directors would step in, evaluate the position of the fund, and evaluate hiring another investment manager to take my place. With that being said, I think that one of the attractive aspects of our fund is that our businesses can withstand a lot of uncertainty. So if there was a period of time that was uncertain, or there wasn't a manager, or our board stepped in and they had to make a decision, I feel very confident that our businesses would continue to perform really well, and that hopefully somebody that they select, because I do trust our board, and I think is a very knowledgeable and independent group of people, that they would make a very good decision. I would also add that some have asked about Rainwater Equity, and you know, I am the sole owner of the company, and I'm financing the business myself. And I feel very confident that I'll be doing that for a long period of time. But I do want the advisors to know and the investors to know that there have been several investors that have offered to invest in our company, and I have turned them away, and don't anticipate taking outside funding for the company. And I hope that gives you confidence that we're very committed to this business. We're very committed to the ETF, and that we will be doing this for a long period of time. Nothing is forever, nothing is for certain, but that is our goal and our planning for today. The second question is on Lore. Um, our compliance officer asked me not to discuss individual securities on this call, and certainly we will talk about individual businesses in more detail at our quarterly update in October, when we put out our quarterly letter or quarterly video. But what I will say about insider sales or buys is, I was actually having a correspondence with Mark Leonard on this topic. But in my experience, insider sales or buys don't tell me a whole heck of a lot about what's going on in a company. Um, to address the question, the insider sales that I've seen have been extremely modest at the company. So it hasn't really moved my opinion much. But when I look back at history and I look at insider buys or sells, it has really not been very helpful in helping me determine what's going to happen to the company. As an example, and just extemporaneously, Hawk Tan at Broadcom, which has gone from being a $3 billion market cap company when they IPO'd in 2009 to now a $1 trillion company or more today. What is that? 16 years later, he's been selling almost the entire way. If I had taken his cue about insider sales, we would have been out of the stock a long time ago, and it would have missed the entire run. So, in general, of course, we prefer business CEOs that don't sell and that buy their shares. But I've not seen a strong correlation between insider sales and stock performance. Conversely, I know this is conventional wisdom. I haven't seen a strong correlation between insider buys and stock performance. I was looking at a company a couple of days ago, which is engaged in an acquisition some years ago. It's a chemical company, did a huge acquisition. Today is overly levered. The stock is down 75%. The business is performing very poorly, and it's probably going to go close to zero. And I saw a couple of days ago the management team and the board, buy some modest amount of shares. Um, that doesn't get me interested one bit. So in my experience, insider buys or insider sales, I know people believe that they're very helpful to helping determine where a stock is going to go. I certainly don't believe that. I think evaluating the company on its own merits is the most important thing one can do in determining where a stock price could be and whether it's something is a good investment. Let's go to the next question.
So the last question is a question that came in around cash positions, and that is that the fund is currently at 20% in cash and around 5% in position in SPY. Could you walk us through your thinking here? Are these placeholders while you look at other opportunities?
Yeah, that's a question from Aaron Hafer, I think.
Yep.
Um, Look, in general, our approach is to carefully invest your money in great businesses. And so if there are periods of time where we think the market is expensive and that opportunities will become more attractive, we will stay very patient in deploying the capital at a time we think is most attractive for our investors. And so there may be times where we carry a significant amount of cash. We don't plan to do that for long periods of time because in general, we think the market will go up over time. And so we want to be fully invested. But there will be periods of time where we think the opportunities may get better and we're going to stay very, very patient with the capital in hopes of making great investment decisions that yield good long-term results. So that's the thinking. We just want to stay patient. We want to have the flexibility to buy things as they get a little bit cheaper. And we think we're going to get that opportunity.
Thank you very much.
And before we
Sure.
before we before we wrap, there have been a couple of questions that came in the chat. The We talked about AI, risks and opportunities there, valuation. Oh, this is an interesting question. Mark Leonard said it in its recent AGM that the stock should underperform the market and other businesses, and Rainwater seem to be elevated valuation. Thanks. Any thoughts on this topic are much appreciated. It's an interesting question. If you go back to the Constellation Software annual general meeting, not this year, but the prior year, I asked a question related to my experience with the business in 2016. I attended the annual meeting in 2016. The stock was at about $600 a share. It could have been 2017. It was 2016, 2017. The stock was at $600 a share, up from 16 when they IPO'd 10 years prior. And Mark Leonard at that meeting in 2016 said he thought the stock was overvalued. A year later, I came back to the annual meeting, went to the annual meeting because Mark doesn't really do meetings other than the annual meeting. And in 2017, when the stock was, I believe, at $700 a share, he again said he thought the stock was overvalued. As you may know, today the stock is nearly $4,500 a share. So last year, I asked in the annual meeting, you thought the stock was overvalued in 2016 and 2017. What did you miss? And he responded that he believed that he had misunderstood the growth opportunities for the company. In general, he's somebody who I think has somewhat of a pessimistic view of the world. So he underestimated the growth opportunities that Constellation Software had over the next 7 or 8 years. Um, it sounds like Moritz said that he said he thought that his own stock would underperform the market in the near future. I don't remember that. He may have said that. but he was not correct in 2016 and 2017. And in my experience, it's worth paying attention to a stock if a CEO is saying something negative about where he thinks his stock will be. Normally, in my experience, the opposite is what occurs. So, I think that he's underestimating where the business will be over the next several years. Certainly, we think that because we own the stock. So I wouldn't be especially negative because he's been negative about his stock for about 4,000 points. I think he's a great CEO, though, maybe the best of the last 20 years. Um, but yeah, so that's kind of how I feel about that. Um, I mean, with that, we're coming up on the hour. Nobody has raised their hand, so to ask a question, and I think there are no other questions in the chat. So I want to be conscious of everybody's time. So we will be doing this, I think, on a somewhat regular basis. And of course, if you have questions or would like a meeting, certainly send us a note, and we would be glad to meet with you. But with that, I'll turn it over to Patrick to wrap us up.
Thank you, Joseph. On behalf of Rainwater Equity, thank you for joining us today and for your interest in the Rainwater Equity ETF. We're grateful for your trust and partnership. If you'd like to schedule a follow-up one-on-one, please email us at rainwatereq.com and we'll be certain to get back to you. We expect to share our Q3 commentary in October, and we look forward to speaking to you again soon. Thanks again.